Okay, in this brief video, we're going to take a quick look at financial management and get a big picture overview of the topic of this semester. So let's get started with this next slide here, the main goal of financial managers. There's one main goal, and that is to maximize the value of the firm. Now we're typically going to be talking about corporations, and so we are trying to maximize the value of the corporation as opposed to a limited liability partnership, a general partnership, a sole proprietorship, etc. There's various ways that you can organize a company. We're in this class thinking about corporations, and the goal of managers is to maximize the value of the corporation. Now notice that we're not necessarily talking about the current stock price, but the intrinsic value of the firm. Now, in an ideal setting, maximizing the value of the firm would mean maximizing the current value of the stock price, but there are instances where managers can manipulate things to just get short-term gains and maximize the current stock price as opposed to the value of the firm. So we really want to maximize the value. That's kind of the theoretical ideal. One thing we're not trying to do is maximize the number of employees. We're not trying to have the biggest workforce. We're not trying to provide jobs. We're trying to maximize the value, and in doing that, if we're selling a good or a service that's valuable in the economy, then we will need to hire people and pay them well in order to produce these goods and services that we're selling. Notice that our goal is also not for social good. We're not creating this business to do good in society, although there is much good that flows from a firm that's well managed and selling things that the economy desires. So it's not bad, it's not a negative thing to do social good, but that's not the main reason of a firm. The main objective or the main function of a firm is to make goods and services that are valued by consumers, and in doing that you are creating social good. You're doing good things for people, for the economy, for the world. So all of that is summed up in this maximizing the value of the firm. If you're not producing goods and services that people care about, you're not going to be able to hire people. You're not going to have a good stock price. You are going to be destroying value and be a drag on the economy. So we can kind of sum everything up again in this one main goal of maximizing the value of the firm. So in talking about the value of the firm, there are three main determinants, and that is in this top section here. When we're looking at cash flows, we're going to be considering the cash flows of the firm, and we care about three things: the size of the cash flows, so how big they are, and we'll examine the size of cash flows when we take a look at the chapters on financial statements, when we look at financial statements and also financial statement analysis. We're going to care about the timing of the cash flows, so there are some chapters on the time value of money, on discounted cash flow analysis. And we also care about the riskiness of the cash flows. What is the risk involved with the cash flows that we're planning on receiving? And so we'll deal with that by looking at a chapter on risk and return. So the cash flows that matter for us when we're looking at firm value are called free cash flows. So free cash flows from a kind of a definitional standpoint are going to be equal to the revenues of the firm. So all the sales that the firm has generating cash. We're going to subtract out operating expenses. So those things that we need to pay in order to run our business. We're also going to need to pay taxes, so we subtract out taxes. And then any new investments that we need to make in the firm, which are also called capital expenses. We need to back those out. And so anything that's left after we've paid for all of those things is going to be called free cash flow. So free cash flow is really what drives firm value. Now, there are two main decisions in finance that we are concerned with, and we're going to look at both of these decisions in a whole lot more detail over the life of this course. So the first decision is investing. And when we talk about investing from a firm's standpoint, we're talking about projects that generate cash flows for the firm. So these might be things like a new production plant, a new manufacturing plant located somewhere in the world. Maybe it's going to be something as simple as a new delivery truck if you're a small business. Maybe just making that extra investment in a delivery truck is going to help your firm. Or even a new product line. Maybe we're a really big firm and we're looking for ways to expand. If we come up with a new product line and that goes well, then we've generated new cash flows for the firm. A second main decision is financing, and that is, how are we going to pay for those investments? So we are making investments by virtue of our investing decision, by coming up with new projects. We got to pay for those investments, and to do that we're going to need a mix of debt and equity. So both borrowing and new ownership of the firm is going to help pay for these investments. So let's look at investing a little more closely. Investments by a firm are intended to bring in cash flows both now and in the future that do something really important. And this is going to be the definition of a good investment. It's going to cover all of the costs of the project, including paying for the capital necessary for the investment. So remember, when we do the financing, we just talked about the financing down here. We got to pay for the investments. We need to be able to pay the suppliers of our capital for the money that they're bringing to our investments. We need to have a firm generating enough cash both to cover all of the costs for the project and to cover the cost of the money that we need. So that is another way of saying that is we need to pay off the debt and also pay a fair return to our equity holders. So we're going to have several chapters that deal with good investment decisions and that show us tools that help managers make good investment decisions. And primarily that area of finance is called capital budgeting. So that's capital budgeting is dealing with the investing decision. Now let's talk about financing. Again, as I mentioned, financing is where we are raising money to fund the investments that the firm is making. So anytime we're growing the assets of the firm, we're going to have to pay for those assets somehow. Now we can do that through debt, and we're going to look at debt very soon when we take a look at the chapter on bonds. We can do that through equity as well. So again, we're going to have a chapter on stocks as well as a chapter on risk and return. Both of these deal with the notion of equity. And then also we're going to be thinking about an appropriate mix of these two, of both debt and equity. And so we'll examine some chapters on cost of capital and capital structure, at least the notions involved there. We may not explicitly get to these chapters, but we are going to talk about the cost of capital and of capital structure. So a big idea here is that money has a cost. There is a cost for debt. Anytime you borrow, you got to pay interest. That's the cost of the debt. And there's also a cost of equity. Anytime you raise money from people, giving them part ownership in the firm, there's an expectation that they will be getting cash flows from their investment. And those cash flows are going to generate a return, and that return is the cost of equity. Now, a big idea that we're going to, again, look at much more over the course of this class is that both of these, both the cost of debt and the cost of equity, are affected by risk. So financial institutions play a big role in helping companies fund investments. Things like investment banks, which help firms raise equity or sell new stock, as well as issuing new debt by selling bonds in the marketplace. There are banks, regular banks, commercial banks that help raise debt, so they'll make loans to companies. And then there are going to be other sources of financing as well, things like hedge funds or private equity. Insurance companies make loans frequently. Pension funds will make investments to help generate returns to support their pension payments. And groups of investors called angel investors, as well as a whole host of others, may provide financing at different points in a firm's life. Lastly, I want to take a look at this big picture here. The top area in this kind of tan colored shading is dealing with the firm's operations and dealing with generating those free cash flows that we talked about earlier. So you got our sales revenue, we're backing out operating costs and taxes, any required investments in operating capital, so those are going to be the capital expenses that a firm makes. The leftovers are the free cash flow of the firm. And the free cash flows determine the value of the firm. So in this middle box here, this greenish box, we can see that the value of a firm is determined by the discounted free cash flows from now until the firm ceases to operate. And we're going to look at this equation in much more detail later in the course. But for now, that middle area, value is determined in part by the free cash flows of the firm. And then lastly, the bottom area here in kind of this purple color is dealing with the financing question. And that's coming up with the right mix of debt and equity, dealing with the costs of those supplies of capital, and that's going to go into the mix as well of determining firm value. So the size of the cash flows and the timing of the cash flows is going to come from the investments that we've made by virtue of running our company. So that's this top area. Financing is this bottom area, and together those two help determine the value of the firm. So we'll get into much more of this in much more detail throughout the course. This is just a broad overview. And so we'll stop now, and I'll talk to you next time.